Welcome to the research desk. Picture two stocks on the exact same day. They are both trading at exactly $150 per share. They both have identical price-to-earnings ratios and identical trading volumes.
Right. So to the naked eye, to any fundamental screener out there, these two assets are twins.
Absolute twins. But their destinies are entirely opposite. Over the next month, the first stock will rocket upward by 40%. The second stock will collapse by 25%.
Which makes absolutely no sense if you are just looking at the surface data.
None at all. So what actually happened? Think about this for a second. The visible realities were completely indistinguishable.
But the underlying reality wasn't.
Exactly. The answer lies in what you cannot see. The first stock is operating inside a persistent bull regime with a 97% probability of continuing. The second stock is just a bear market bounce, mathematically destined to resume falling.
And that brings us to the core of what we are unpacking today. We are looking at the Hidden Markov Model.
Yes, a 200-year-old mathematical technique. We use it to decode these invisible market states. I argue that the Hidden Markov Model is the definitive lens for understanding true asset trajectory, stripping away the noise of price action.
And I approach this premise with a deep degree of caution. I acknowledge the mathematical elegance of the model, but I have to ask if this is the ultimate truth of market structure or just a dangerous mirror reflecting the past while we drive into the future.
That is the tension we need to resolve. Let us start by addressing the fundamental flaw of chart reading. This is the primary tool that 99% of market participants rely on.
The classic point-in-time trap.
Exactly. Let us go back to our hypothetical stock at $150. You pull up a candlestick chart, you see that 2 months ago, the asset was trading at $120.
So now it is at $150. It looks like a classic recovery.
It does. To the human brain, which is biologically wired to recognize simple geometric patterns, it is a diagonal line moving bottom left to top right. Investors buy in, completely fooled by the trick of coordinates.
I understand the skepticism of basic chart reading, but calling it a trick of coordinates is a bit dismissive, isn't it?
Well, a snapshot only tells you where the price is at a specific second. It does not tell you the velocity field driving that price. That $150 mark could be the early phase of a genuine bull run with a 95% persistence probability.
Or it could simply be a brief upswing in a bear regime.
Exactly. A bear regime where the underlying state still has a negative mean return and a 93% probability of remaining bearish. The visible data is identical, but the invisible state is completely different.
I have a major issue with dismissing visible data in favor of an invisible mathematical construct. Price action and fundamental screens are not optical illusions.
They are lagging indicators, though.
But they represent actual, tangible capital deployment. When a stock moves from $120 to $150, that requires millions, sometimes billions of dollars of real buying pressure.
Sure. But that doesn't define the structural state.
But you use the term velocity field to describe this underlying state. Isn't velocity field just a fancy academic way of saying momentum?
Not at all.
Why not? If a stock exhibits strong buying pressure, we can see that empirically. Why do we need a massive, computationally heavy algorithm just to tell us a stock is going up?
Because momentum and statistical state are fundamentally different concepts. Momentum requires the price to have already moved significantly. It tells you what is happening on the surface.
And the statistical state?
The statistical state is the underlying environment that makes the momentum possible in the first place. Let me use a deliberate analogy here. Imagine you are locked in a windowless room.
Okay, no access to the outside world.
None. Every hour, someone passes you a note under the door with 3 numbers: temperature, humidity, and wind speed.
So from those secondary readings, I have to deduce if it is sunny or raining outside without ever looking at the sky.
Precisely. You are looking at the exhaust to determine the state of the engine. And you can do it provided you understand that weather follows probabilistic patterns. Sunny days produce specific temperature distributions.
Right. And rainy days produce entirely different ones.
The Hidden Markov Model does exactly this for financial markets. It infers the invisible weather, the market regime, from the temperature readings of daily, logarithmic stock returns.
Without ever directly observing the fundamental news or the macro environment.
Exactly. It simply looks at the math. The model discovers three distinct regimes on its own. First, the bull regime. This has a high mean daily return, 15 to 40% annualized, with moderate volatility. This is the state of conviction.
And the second state?
The flat regime. Near zero mean return, highly variable volatility. It is the ambiguous middle ground of sector rotation. Third is the bear regime. Lowest, negative mean return, highest violence and volatility. Liquidity reversing out.
The windowless room analogy is beautifully constructed, I will give you that. But it assumes the weather outside operates on predictable physical laws.
Financial markets have statistical laws.
They are chaotic human systems. They are prone to mass panic, irrational exuberance, structural breaks. This brings us to the fatal flaw in the mathematics powering your model.
You are talking about the Baum-Welch and Viterbi algorithms.
Yes, let us pause on these for a moment. Baum-Welch is essentially an expectation maximization tool. It looks at messy data and tries to find unknown parameters. Viterbi is a pathfinding algorithm that works backward to find the most probable sequence of hidden states.
Which is exactly how we decode the regimes.
But their core assumption is the problem. They assume Gaussian returns. They assume market movements fit neatly into a bell curve. Real financial markets do not obey the bell curve.
They have fat tails, yes. We know this.
Severe fat tails, extreme events, crashes, massive short squeezes. These shatter the bell curve. How can a model built on normal distributions survive a market that is fundamentally abnormal during crises?
Because the Gaussian assumption is just a mathematical categorization. When those fat tail events occur, the model categorizes them into the bear regime, which naturally accommodates higher variance.
But it forces violent human behavior into clean mathematical buckets that do not exist in reality.
It does not break, though. It simply shifts the probability weight. And this brings us to the most critical revelation of the entire framework. The power does not lie merely in labeling a state bull or bear.
You are talking about the transition matrix now.
I am. The punchline of this entire system is the persistence probability. This is the single number that changes everything. It is the diagonal of the 3x3 mathematical grid, showing the exact likelihood of the current regime surviving until tomorrow.
So it measures how sticky the state is.
Exactly. Let that land for a second. Two stocks might both be labeled bull, but the difference between an 82% bull and a 97% bull is everything. An 82% persistence is fragile.
It could flip next week.
Yes, but a 97% persistence is a structural, unshakable tailwind. Let us look at NVIDIA from mid-2023 to early 2025. This was the ultimate bull case.
With massive gains, but a terrifying ride for anyone actually holding it.
Utter psychological terror. Constant 10 to 15% pullbacks. The financial media was calling the top of the cycle every other week. Retail investors were panicking over basic charts.
But the statistical state remained stable?
The Hidden Markov Model decoded a 96 to 98% persistence probability in the bull regime through that entire period. It mathematically proved the violent pullbacks were just noise within a bull distribution.
Giving you the conviction to hold. I see the value there. But what about the inverse?
Let us look at a classic Chinese tech value trap in late 2023. A major e-commerce conglomerate, down 60%, trading at a 5-year low with a 12 PE ratio.
I remember that. Analysts everywhere were calling a bottom. Every fundamental screener flagged it as a buy.
Undeniable. But the Hidden Markov Model showed a 93% bear persistence, and it showed that state had been running for 200 days.
So it completely ignored the fundamental valuation.
Completely. And what happened? The stock fell another 25%. The transition matrix is the ultimate arbiter of reality.
The contrast is stark, but it exposes the inherent lag in how the transition matrix operates. You praise the 97% persistence of NVIDIA, But you must acknowledge that the Viterbi decoder is strictly backward-looking.
It processes historical returns, yes.
So a 97% persistence is not a prediction of tomorrow. It is a highly precise description of yesterday. Regimes flip violently and suddenly.
But high persistence proves structural stability.
High historical persistence can breed dangerous complacency. If an investor sees 98%, they are mathematically conditioned to ignore warning signs. They hold through a 10% pullback, assuming it is just noise.
Because statistically, it usually is noise.
But what happens when it is actually the beginning of a black swan event? The model only confirms the regime change after a sequence of new data has been processed. You only get the confirmation after your capital has been destroyed.
The mathematical lag is a reality, but waiting for mathematical confirmation saves vastly more capital than it costs. We choose certainty over emotional forecasting.
Fair enough. But let us talk about when the math gets confused.
You mean the flat regime trap. This is the blind spot, the most dangerous misread state in the entire system.
Because a stock classified as flat with 95% persistence could just be range-bound garbage.
Exactly. It could be going absolutely nowhere, or it could be a gently, quietly trending stock making steady gains. The daily returns just aren't violent enough to trigger the bull threshold.
So the model struggles to differentiate a slow compounding trend from pure sideways chop.
It does, because it strictly analyzes the geometry of daily logarithmic returns. This is where we require outside help. We integrate the TrendWise tiebreaker.
Okay, break down how that tiebreaker works.
If TrendWise is open, meaning bullish momentum, the persistent flat regime gets a positive 3-point modifier. If closed, it gets a negative 2-point modifier. We saw this with a consumer staple stock recently.
Let me guess. High flat persistence?
98% flat persistence. Without context, you ignore it. But it was delivering a steady 12% annualized gain. The daily returns were too quiet for the bull distribution, but the trend was real. The tiebreaker solves the ambiguity.
This is a major structural contradiction in your argument. You started by championing the Hidden Markov Model as the all-knowing lens superior to simple price action and momentum.
It is superior.
Yet, the moment it encounters a low volatility trending stock, it completely fails. It incorrectly labels a steady 12% gainer as flat. And how do you fix this mathematical blindness? You use TrendWise, which is literally a momentum overlay.
It is not mathematical blindness.
If the model requires a momentum tiebreaker, then the invisible state is not the ultimate truth. By hard-coding only 3 states, the model forces nuanced behaviors into artificial buckets.
It is a strict adherence to volatility parameters. The integration of TrendWise is a feature of a multi-layered system. But this intersection actually brings us to a deeper structural revelation.
Regarding strategy backtesting?
Yes. When we ran comprehensive strategy backtests against the decoded sequences, we ran 3 strategies: momentum long bull, short bear; mean reversion, long bear, short bull; and simple buy and hold.
And the findings?
The winning strategy is not a timing signal. It is a permanent biological trait of the asset itself. High persistence, where the diagonal is greater than 0.9, strictly demands a momentum strategy.
So geometric order 1. Steady trend velocity is the natural equilibrium.
Exactly. Conversely, low persistence below 0.8 demands mean reversion. For most large-cap equities, regimes are highly persistent. Momentum is the mathematical imperative dictated by their statistical biology.
Calling it a permanent biological trait is a massive, dangerous extrapolation. You fit a backward-looking model to a historical dataset and declare it a permanent reality.
Because the statistical biology is robust over time.
But what happens when that asset undergoes a fundamental business model change? A tech company might be a high-persistence momentum stock for a decade, but as its market saturates, it transitions into a mature, dividend-paying utility.
The math will eventually reflect that.
Yes, eventually, but its statistical biology alters entirely. It goes from momentum to range-bound mean reversion. If you blindly trust a historical fit, you will apply a momentum strategy to an asset that has fundamentally altered its core economics.
The transition probabilities continuously update. It adapts. But I want to shift to where the hidden markup model demonstrates its absolute highest value, its ultimate defensive power play.
Refusing to catch falling knives.
Yes. Let me set the scene. You are looking at a stock. It has 4 green gravity walls. It is in phase 4 on the market clock, deep value territory.
Cheap PE, beautiful narrative, every fundamental cell in your body screams buy.
Without the model, you deploy your capital immediately. But the model issues a hard veto. It decodes the stock as in a persistent bear regime with a 94% diagonal probability running for 180 days.
So the fundamentals are right about the value, but the market isn't ready to listen yet.
Exactly. The invisible statistical state is still grinding lower. The discipline is to wait. You wait until the bear diagonal drops from 94% to 85%, or until Viterbi assigns a flat or bull state.
Getting in 15% lower.
Entering 15% lower is worth avoiding months of capital destruction.
Trade-off of that lag. Viterbi lags real-time price action by 5 to 15 trading days.
It needs sequence confirmation.
But market bottoms are violent V-shaped reversals fueled by short covering. The first 5 to 15 days of a recovery are the most explosive days of the entire multi-year cycle.
They can be, yes.
So by waiting for the statistical break, you mathematically guarantee that you will miss the exact bottom. You structurally give up the best 15% of the upside. Is that a worthwhile price for statistical safety?
Missing the exact bottom is a very small price to pay for ultimate survival. The graveyard of finance is filled with fundamental investors who tried to time the bottom and were crushed by a persistent statistical regime.
You give up the explosive return for confirmation.
The goal is not perfect timing. The goal is confirmed structural alignment. And this brings us to how the system is actually integrated. The model is not an isolated oracle.
It sits within the broader 6-layer framework.
Yes, below Shannon entropy, which governs signal reliability, and below the geometric order hard gates, it acts strictly as a modifier. A persistent bull adds 5 points, turning a buy into a strong buy. A persistent bear subtracts 5 points.
It nudges, but it does not dictate. Well, since we are defining its exact place, we have to look at the 5 honest boundaries, the limitations of this model.
Let us lay them out.
First, it is backward-looking. Second, the undeniable 5 to 15-day lag. Third, the rigid 3-state architecture. I mean, Bitcoin desperately needs 4 states, while a stable utility only needs 2.
Forcing them into 3 is a compromise, yes.
Fourth, the Gaussian fat tail flaw. It underweights extreme events. And fifth, the most frustrating limitation, initialization variance.
That one requires some unpacking. How can we trust an algorithm if we have to restart it a dozen times just to get a reliable baseline? Explain what is actually happening under the hood.
It is the dark secret of complex machine learning. The algorithm begins entirely blind. It has to guess the starting probabilities. If its initial random guesses are poor, it gets mathematically trapped in a local optimum.
A mathematical dead end.
Exactly. It is like trying to find the highest peak in a mountain range while blindfolded. You stop at the first small hill and assume it is Mount Everest.
So you have to run it multiple times?
You have to run 10 to 12 completely different restarts with randomized parameters just to find the true global optimum. That computational fragility should give any investor serious pause.
I accept those limitations as boundaries to respect. Despite the initialization variance, the lag, and the Gaussian compromises, the transition matrix offers an unparalleled defensive shield.
I can agree with that. Knowing the persistence probability really is the only empirical way to separate a temporary bounce from a structural regime shift.
It provides the crucial mathematical context of the invisible environment. Which leaves us with a final thought. If the invisible statistical state is powerful enough to override perfect fundamentals, are we actually investing in companies anymore, or are we just trapped in the math? This is the Research Desk officially signing off.